Okay, hello everyone, and welcome to our panel on unlocking capital for the global energy transition. I am Jackson Ewing. I'm the Director of Energy and Climate Policy at the Nicholas Institute. Thank you to Ronnie and to President Price for those introductory remarks. We are facing an unprecedented challenge in the global energy transition. We need to provide levels of energy across low and middle income countries that don't just lead to basic electrification, but rather lead to a range of systems that are necessary for true human development and flourishing. Meanwhile, our carbon budget makes it an imperative that we do so not on the backs of fossil fuels or traditional industrialization methods, but rather on the backs of clean energy. While this is certainly possible, and we're going to hear some examples this morning of how it's happening, it's also difficult, and it's going to, as President Price said, require an enormous amount of money. It's not just the quantum of finance that's necessary, but also the types of finance and the innovative strategies that are deployed in these contexts that will lead to their successes or failures. We have an excellent panel to discuss these issues, both challenges and opportunities. We have Will Demas, who's the head of Americas for Green Investments at the Macquarie Group. We have Anmay Dittman, the head of climate finance at BlackRock, and we have Kate Steele, founder and CEO of Nithio. Just one bit of housekeeping before we begin. We do have Slido QR codes to our left and right. You're welcome to scan those and submit Slido questions, and I may or may not get to them. Kate, let's start with you. You've worked extensively at Nithio and in your previous role at the USAID on strategies to de-risk energy sector financing in Africa. Let's start with evaluating those risks themselves. What are the most formidable risk barriers to finance on the continent? How well-informed are risk calculations? Is there a delta between real and perceived risk, and so forth?
Sure, thanks, Jackson. And thank you for convening this day, but also this session, because I think it's really important to be able to talk through how these energy transitions happen. I've spent my whole career focused on energy access, energy transition, primarily focusing on sub-Saharan Africa. And I think this question is really on point, because what I've seen, even going back before USAID, I was at Google looking for large-scale renewable energy investments on the continent. And we found there is this gap in terms of perception of risk and real risk. And so you have investors that look at the continent, see a lot of opportunity, want to come in, but then from Power Africa, we'd be trying to provide all these risk mitigants. And you'd be able to provide guarantees, you'd be able to provide funding for feasibility studies, all of these things that would cover all the risks. And then we found investors still wanted kind of frontier returns. And so you've got this very gold-plated package where you really can't lose money, but you're still looking for an IRR that assumes you're taking a huge amount of risk. We found there's a big gap there. I think there's also a gap in understanding of the reality of political risk, how likely that is to happen. You can get insurance against that, but it's also relatively unlikely. And we found everything came back to, financing's relatively simple. Are you going to get paid back or not? And how confident are you about that? And we found markets that were relatively good for investment, like Kenya. It was because the power utility has never defaulted on a PPA. If you can set that standard, you can get a lot of investment. You had other countries that were signing power purchase agreements, a year later canceling them, there was an election, things changed, a lot of uncertainty. Uncertainty doesn't tend to breed investment. What we do specifically at Nithio is we look at its extremely specific risk of repayment rates on pay-as-you-go solar. So pay-as-you-go off-grid solar has unlocked a vast opportunity for bringing first access to a lot of remote, rural, and peri-urban households, which is great, but I think there's actually been a misperception of how good those payback rates are. Everyone likes the story of you break the payments into small enough quantities, people can pay back, it matches kerosene pricing, and relatively reduces the risk. That is true, but you're still selling a relatively expensive product to a household with very little ability to pay for that product. And so what we were trying to do is expose more of the real repayments, not to say this isn't working, but to actually price the risk accordingly. And so we've actually been trying to bring in more risk rather than say there's not risk, but to say if you understand risk, you can price it and you can still serve that market.
Yeah, that's really interesting that term bring in more risk. I want to ask you.
Bring in understanding.
Yeah, exactly. I want to ask you to go a little deeper on the Nithio story. I mean, you guys are involved in clean cook stoves and solar irrigation, solar home systems. Tell us a little bit more beyond just the risk calculation of how the projects work. What are some success stories? What have you been learning over the period of this work?
Sure. So when we were starting to think about founding Nithio, it was looking at what was a great product market fit in terms of small-scale energy systems for rural households, for off-grid households. And I think pay-as-you-go was really revolutionary in that you had a basic system or clean cooking or other technologies that really fit what was needed in those households and could break apart the payments into a way that was able to be kind of easily paid by the household, and also where they didn't accrue lots of penalties and interest if they had to stop paying for a while. So our households with very inconsistent incomes, but you could pay for your solar home system. If you have a break where there's a funeral, there's school fees, whatever it is, you can stop paying for a period of time. The system is not on, but you're not getting into deeper and deeper debt. This was great. But we saw that there were two challenges with companies in this space that were trying to scale. One was this challenge of understanding that repayment rate. You're offering a ton of flexibility, great, but you have no idea how that money is going to come back to you. And that's really hard to manage your own cash flows. It's extremely difficult to turn around to an investor and say, we're going to sell 10,000 of these systems, and we think most of the money is going to come back over this time period. And so we developed a model where we could say, okay, we have an AI model that clusters those different payment patterns, understands what those repayment trajectories look like, time bounds them, and backs out what the net present value of that receivable is. So that gives a real banking term to what is happening with pay-as-you-go. We then offer receivables-backed financing against that. We intentionally developed a permanent capital vehicle instead of a fund because a lot of companies had a pain point around needing to get working capital consistently, not having to just go back out to market to fund after fund after fund. So that's what we did. We developed this analytical tool. We use that for our own investing. We also sell it as a standalone. And then we have a permanent capital vehicle where we lend to initially companies in the solar home space, and then we've done solar water pumping. We're looking at a lot at clean cooking and e-mobility. E-mobility is very big, especially in East Africa right now. And so looking at how we can finance electric bodabodas, electric bicycles as well.
You know, Kate, I don't know if this is a fair follow-up, but I'm going to ask it anyway. You've just given us a nice explanation of how you assess the likelihood of repayment in given context. Can you say more about what the different forces and variables are that lead to that repayment being possible at a household level?
Sure. So I think it's an interesting story from one of the companies that we worked with a while ago that they, actually when I was at Power Africa, that they could actually back out a household's likely occupation based on their payment patterns. So you have, and we always see this with, the first thing we do is run this clustering model to look at different payment trajectories. Pay-as-you-go offers a lot of flexibility, but there's always a piece of the market that pays back as if it was a kind of traditional loan. They make very regular payments. They pay back within the time period expected. The next group is kind of moderate repayers. They're taking some advantage of the flexibility. They are consistently paying, but maybe with some interruptions throughout, and just they're not going to pay back within the expected time period, but maybe within 2x they will be paid back. There's always a group that is not really paying back. They're paying enough to keep the system on, maybe once a week. They probably have very low, very inconsistent incomes, and realistically, they are not going to pay off the system. What we've been really careful to not do is say, okay, well, those households you shouldn't be serving. I think if we were entirely private sector oriented, and if the companies were too, they would say, like, let's find those households and not provide access to them. I think that's not really what we're trying to do. We want to say there's a type of capital that matches each of those. The market is starting to move a little bit more towards securitizations, and you can kind of squint and see a world where you could actually have off-balance sheet receivables tranched by what type of customer they are and actually matching capital to those different tranches. So we think that, again, information is key to matching what types of payment patterns there are and how do you actually match the correct capital to serve those households so you can reach everyone.
Yeah, that's fascinating. I'm going to switch gears slightly for my last question for you for this phase of the discussion.
I feel like I'm in the hot seat on this.
You formerly served as Energy Director for USAID's Power Africa program. So what were some of Power Africa's key achievements during your time, and how do you view the vacuum that's being left by USAID?
So I thought Power Africa was a fantastic program. The reason I moved back from California to DC, left Google, was because we had been trying to do large-scale solar, large-scale wind investments in a lot of developing world, especially in Africa, and found that there's still a lot of risk. I'd actually gone to Google because I thought more of energy access was going to move to private sector, and found that the role of Power Africa with not using US resources to build infrastructure, but using those resources to leverage private investment, and to say, well, what's the key bottleneck? Do you need a feasibility study? Do you need to work with a utility? Do you need to work with a government? Do you need financing from Development Finance Corporation? Do you need a guarantee from them? All of that, to bring those pieces together, I think was fantastic. I've seen the estimate, things happened after I left, but I think the return on investment for leverage was, for every $1 US put in, it leveraged 24, so 24x return on those investments. That's a huge leverage ratio, and brought in an enormous number of US companies to the space. I do think that there's still a lot of support for Power Africa, to be honest, and I think you'll start to see pieces of it bubble up, probably not from USAID, obviously, but from different sources. I do know people who transitioned immediately to supporting the companies from more of a private sector role because this support is still wanted. But I'll be interested to see when things shake out where that motivation sits within the US government, because I do think it was exactly what we need to be doing in terms of supporting US companies.
Thanks. That's heartening to hear that there'll be that continuation.
I might be overly optimistic.
I'd be 24x. That's an amazing ratio, so very impressive. Anmay, I want to move to you at this point, and I want to begin with some of what I see as BlackRock's really fascinating international partnerships. And I'll just bring up a couple of them to tee us off. The first is the Climate Finance Partnership, which was established collaboratively with sovereigns in France, Germany, the US, US impact organizations, I should say, Japan. And it's focused on investing in climate infrastructure across emerging markets. Similarly, we were all really, I think, taken I don't want to say taken aback. The announcement at COP28 in Dubai of the Altera partnership really gained the attention of the international climate finance community, and it's a really interesting fund. And I wonder if you might just talk us through how some of these partnerships formed, how they work, and how BlackRock sees its presence in this international landscape.
Thank you so much for the question, Jackson, and thank you to everyone here, and really applauding Duke convening this for the second time on this very important conversation that we're having. And actually, the Climate Finance Partnership, I'll start with that because that was the precursor to the Altera commitment, so they're actually interlinked. But maybe I'll tell the story of the Climate Finance Partnership to really show how we went from the initial phase to something much larger with Altera's commitment now to the program. So the Climate Finance Partnership began really at the end of 2018 at a One Planet Summit. It was hosted by President Macron, and Larry Fink, our CEO, was at this summit. And it was the question that we're talking about today, right? How do we mobilize private capital? Because we know that it can't just be public capital. We know that private capital can't do it alone either, given the risks that Kate was just talking about. How do we mobilize that private capital? How do we get them comfortable to come in at scale into emerging markets, into climate infrastructure, into those regions that are really climate vulnerable, need it the most, and frankly, that's where the demand is, the energy demand is, and where the access to energy is so life-changing for those communities. I mean, we're very fortunate being where we are today. Here in this audience. So that was in 2018, and so of course I had just actually started at BlackRock, and I get the lucky job of figure this out, put together a vehicle that combines public and private capital that will mobilize private capital at scale. And those institutions that you mentioned, so we received seeding catalytic capital, we'll call it. And I can explain a little bit more about catalytic capital in a second, but it's really more flexible subordinate capital in the capital stack from the DFIs, the development finance institutions of France, obviously, because it was Proparco, and Germany. And then we had these leading US impact organizations that were also involved at the very initial outset. So we worked with them, we worked together with them, we worked collaboratively with them. And that's actually kind of unusual, as you're pointing out with BlackRock, because typically when you do a fund product at a private firm, you create the product and you basically market and you sell the product. You have investors that are interested in it. This one we actually worked closely with our public partners. It was not in our philanthropic partners. It wasn't just we came up with it and we said, oh, it's ready. We worked with them, and what was important was really combining not just the capital of the institutions, but the intellectual property. How do we do this? How do we do this in a way that will satisfy, obviously, the public sector clients in this, but also what would, and from the BlackRock side, what we know would resonate with private capital, because if we can't bring them in at scale into this vehicle, we would have failed at the mission. So we were able to launch this, and then Japan came in afterwards, and then of course we brought in the private capital. Not at 24x is a little hard to beat, I would say. For every dollar of that catalytic capital, we brought along $4 of private capital. And so we were able to then combine that capital and then, of course, invest into these markets. Then, fast forward COP28. Altera, who, in case the audience isn't aware, that's the $30 billion climate facility that was launched at COP28 by the UAE. They allocated capital to BlackRock, a portion of which was to the follow-on strategy to CFP. So we received seed capital from Altera to basically now build. They were so, it was really validating, right? Because they were really pleased with the success of the climate finance partnership that they, sight unseen, said, we want you to seed the follow-on fund with our capital. And they also provided co-investment capital as well to CFP1.
Thanks, that's great. I'm going to ask you to go just a tiny bit deeper on Altera, because I think that the approach taken was quite innovative. We've all talked about the need for these catalytic marriages. You've just described how one worked. But Altera is using this capped returns approach that is a little bit different than some of the mainstream strategies that have preceded it. So how does it work? Yeah,
so with CFP, with the original fund, what we had was first loss capital. So we had concessional capital, first loss capital, where, in other words, those catalytic investors that I mentioned, including the philanthropies, they basically take that first loss should the fund experience a loss. They are the first to experience that loss. It's effectuated through a distribution waterfall, so that's how it works for the first fund. Altera, as you rightly point out, so they actually, the $30 billion climate facility comes with $25 billion of what is called acceleration capital, and $5 billion, which is called transformation capital. The 25 billion of it, so most of it, is regular way capital that they've invested in a number of products, including other BlackRock platforms, into the climate infrastructure assets across the world with other managers as well. But it's that 5 billion that has this cap return profile. And what that means is that they will forego returns above a certain hurdle. So they set a certain level of return that they will receive, and then it's capped. So they don't get a dollar more. And so the idea, so the first tranche of capital that I mentioned, the first loss, that is to help people with risk, right? That is to basically say, private investor, you're a little bit worried about going into these markets, and so, I'm going to make you a little bit more comfortable because we've got other capital that will basically give you that buffer, if the fund should experience loss. Cap return, however, says, I will juice your return. So in other words, because the level is set obviously at a level that should easily be met, and your target hurdle is well above that cap level, every amount, every dollar above that goes to the rest of the capital stack. So one is a risk buffer, the other one is a return booster.
Mm-hmm. Sure, thanks for that really cogent explanation of something that's quite complicated. Look, I want to take us from the helicopter view down to the ground level, because roughly 2 years ago, CFP acquired a stake in the largest wind farm in Africa, in Lake Turkana. So what went into that decision? Do you see BlackRock expanding these types of acquisitions in the future?
Yeah, no, we're really so pleased to be an investor in Lake Turkana Wind Project. And for those of you who might not be familiar with this project, I know Kate must be. It is the largest operating wind farm on the continent, and supplies, on average, I mean, it depends, but on average, 12% of Kenya's power. So it is a marquee project that is really delivering on the energy needs of the country. And it's also one of the lowest cost providers of power to the country. So you know, in all respects, we were so pleased to be able to be a partner with the other investors in that project. But when we looked at it, it was hard. You know, I won't lie, you know, I mean, you know, as Kate mentioned, you know, like we go through our processes at BlackRock like we would with any investment. And so there's a level of course, incredible robustness and rigor to make sure that the investment, you know, profile is underwritten in a way that is fine for all of our investors. And while we, of course, have that risk buffer that I mentioned, we don't intend to use the risk buffer, right? Like that for us would not be what we want to do. And so when we looked at this project, we saw the returns. Kate mentioned that Kenya has never defaulted on a PPA. These are the considerations that we looked at, and we thought, you know, the impact was amazing. And then, of course, the returns were also in line with what we were looking to do. And then maybe the most special part about this that we're excited about is that the expansion opportunity. It is on tens of thousands of acreage. And the project itself is not on, you know, it's just using a portion of it. So it has one of the best wind resources that you'll see, as well as solar irradiation as well. So we just saw that, great, you know, this project is up and running. It's already doing, you know, really good work for the people of Kenya. But we can also expand it, because the hardest part about doing this project is the transmission. Because going from where you have the source and to the load, it's very, very, you know, it's far treacherous. I mean, of course, because when you have that type of wind resource, it's not going to be in a local city, right? It'll just blow you away, you know, literally. And so that was the hardest part. So having that line already up in place, which took a really long time for that construction, having that substation there, and having additional capacity available in that line means that it is a perfect candidate for expansion to provide even more low-cost energy to Kenyans.
Yeah, I'm really glad you landed on transmission at the end. It's so often a bottleneck, and in this case, it was really an enabling factor. Last question for you, Anmay. Earlier this year, BlackRock, withdrew from the Net Zero Asset Managers, which is a sub-alliance of GFANZ, the Glasgow Financial Alliance for Net Zero. You weren't alone in that. What were some of the main drivers of BlackRock's withdrawal, and how do you see these types of global coalitions moving forward, GFANZ specifically, or more broadly?
Yeah, and I'll start with the last part of that question first. I see it as being really more important. This is why these conversations are even more important than they were before. So BlackRock, of course, reviews its affiliations on a regular basis. And I think one of the things, I mean, it's no secret to everyone in this room, that BlackRock received a lot of, we thought, you know, unwarranted sort of challenge because we were providing these type of products to our investors. BlackRock provides products to investors that investors are seeking. We don't, you know, we have products for everyone. So whether it's in the climate space, whether it's not in the climate space, it's offered to everyone. But some of Larry's, I think, outspokenness on the topic really confused some of our clients in a way where there were legal challenges even you know, that we received from states where they were withdrawing their capital from the products that we did have due to, I think, really some confusion as to where BlackRock was. So I think we reviewed those affiliations and then decided, like you said, along with others, to step away from it, to kind of take down the heat. But I will say it hasn't changed, and maybe this is the critical point, is it hasn't changed what we do. Maybe the way we talk about things have changed, but it hasn't changed our mission to providing the products that our investors are seeking. And this is exactly why the work of these other organizations are even more important today, I think, than before.
Thanks so much, Anmay. Will, I want to move to you, and similarly to the questions I asked to Anmay about some specific funds and projects that BlackRock has ongoing, I want to begin by asking you about the Macquarie Green Energy and Climate Opportunities Fund, and the portfolio representing over 17 gigawatts of green energy capacity across various regions. So how do you go about identifying promising large-scale investments in the energy transition?
Thanks, Jackson, for having me. Thanks, everyone, for being here. And also need to thank Walter Pye, who's a Duke alum, who, as a colleague of mine, who graciously invited me to participate here. So looking forward to chatting. I'm going to answer your question eventually, but I'm going to start with a little bit of history around Macquarie and how we got to this. I can't call it a fund, just to be clear. My compliance people aren't here, fortunately. But Macquarie, for those that don't know, is a large Australian financial institution, which really our DNA is in infrastructure. We would very humbly say that we may have even created an asset class called infrastructure 40 years ago. So we've been investing in things from bridges to toll roads to airports to generation and expanding beyond that now. We have actually been investing in energy transition and renewable energy for 2 decades. So while we're really excited about the focus and the acceleration of the deployment of capital into the energy transition today, this is not new for us, right? So we've invested over $17 billion in those 20 years into things like solar, wind, battery storage, hydrogen, et cetera. And we've, that's over 100 investments, and we've exited over 50 investments. And so we've really honed our skills in terms of investing. A lot of that initially was off of our company's balance sheet, so investing our own Macquarie shareholders' capital into these opportunities. And a few years ago, when our group became too large to be supported just by our balance sheet, we decided to start an asset management business and raise energy transition-focused third-party funds, compliance. Okay. The fund you referred to is MGECO, which is our open-ended fund that invests in the more mature portion of the energy transition, which we define as the decarbonization of the electricity sector, which obviously is solar and wind and geothermal, hydro, transmission. All of the things that we've been investing in for the last 10 or 20 years have been, these are now massive global sectors. There's trillions of capital going into these sectors, and there's a different risk return for those types of investments because they've been de-risked and they're mature, and so there's a different cost of capital for those investments. And so the 17 gigawatts you referred to actually are investments that we made in advance of raising this initial strategy. That was facilitated by our balance sheet. So our balance sheet lent us about $1 billion to, seed a fund so that when we went to investors, we actually had a portfolio of stuff that they could look and see, and it wasn't a blind fund. It was, there's already 6 investments here, and this is what we're going to do. This is how we're going to do it. We're going to do more of this, but it's not sort of a guess as to how we're going to pursue the strategy. So that 17 gigawatts today is probably more like, 95 gigawatts since we've made follow-on investments of development under construction operating assets. We've got this is a global fund, and we're global for many reasons, which I think I'll talk about later. And the reason why we've created it as an open-ended structure is because the trillions of dollars that have to go into this sector to get to whether it's net zero or just a more decarbonized phase. We don't see the purpose of, since it's a multiple decade opportunity, we don't want to invest in a company that we really like and then be forced to sell it in 3 to 5 years because we have a limited fund life. We want to continue to deploy our clients' capital into these high quality businesses. And if we were to sell, we're not religious about holding things forever, but if we were to sell, there would still be opportunity to do more. So why would we sell a company when we're just going to have to pay for a new one, right? So we just want to support the investments we make for as long as we can with really stable and reliable capital that wants to invest in these sectors.
Yeah, that's a perfect segue to where I wanted to go next, which is downstream in this value chain towards the companies themselves. And we've talked in advance of the panel about Calibrant, which is a distributed generation business. It's kind of a soup to nuts with financing, design, building, owning, operating, managing energy infrastructure, and providing long-term contracts. That has subsequently led to an acquisition of NLX's DER business through Calibrant. And as a result, you have a combined business that can provide storage backup power to data centers, an issue that we're going to get into here in more detail later this afternoon. So tell us a bit more about that partnership and how it came to be and how you view this intersection of technology and power sectors and the global opportunities that Macquarie sees there.
Well, I'm impressed that it took 45 minutes to say data center. So
I think Ronnie said it earlier.
Or maybe I missed it. But yeah, so Calibrant actually is an investment that we actually created. It's a platform we created from scratch several years ago that initially focused on distributed generation and providing energy as a service to commercial and industrial clients, whether that be through behind-the-meter solar, behind-the-meter batteries, even have some wastewater things and microgrid things we do in that business. That actually began as a partnership with Siemens, the global technology company, and we were doing well in that business for several years. But for those of you who are familiar with distributed generation, it's very difficult to scale, right? Even if you're doing a good job, even if you're doing it profitably, it's really a sales and marketing machine at the end of the day. And so we decided to do something a bit transformational and acquired Enel's DER business, which was a long time ago called Enernoc, for those who've been in the industry for a long time. And the reason why we thought that was an interesting opportunity, because NLX's business had really evolved into being a provider of behind-the-meter battery storage solutions for data centers. And we thought that was, obviously it's an incredibly growing market. It's a great opportunity. Calibrant, as it existed, did not have that exposure. And so we saw a lot of value putting those two strategies together. We did that, bought that business last year. And now really 90% of the pipeline is in fact providing energy solutions for data centers. We'll be announcing soon a few partnerships and with the largest hyperscalers in the world to do a multiple site, multiple gigawatt rollout of batteries behind the meter for their data centers around the country. And so, that's not necessarily purely energy transition. That's also for reliability. That's for, for grid backup. But we really think that the intersection between power, tech, data is really, really apparent, and it's really relevant to the energy transition. And in fact, another strategy different than the one I talked about earlier, we call it MGETS, which is our energy transition fund, sorry, I shouldn't say that again, that focuses on sort of the more emerging areas of energy transition like battery storage and green hydrogen and renewable fuels, et cetera. We actually have a sleeve within that strategy where we can actually invest in infra-enabling technologies, infra-enabling service business, so not asset-heavy businesses, but businesses that are completely aligned with the heavy asset stuff that we do, but is providing, facilitating the building and operation of those businesses. So there's a huge confluence right now of infrastructure investment mindset with tech investment mindset. I can't say we've got it perfectly right, but as an institution, we've done both, so we're trying to leverage that.
Yeah, certainly. I'd argue no one has it perfectly right, and that's an impressive story. Will, you cover the Americas, and one of the headwinds we see in investment flows into low and middle income countries around the world is that there are other places those investments could go that are more familiar, are in some cases more stable, or at least the perception is that they're more stable in terms of the returns that one might expect. So how do you go about making decisions about investing in the US or its near abroad versus investments further to the south? And I know Macquarie's been quite involved in multiple wind and solar projects in Brazil, but thinking about that in kind of in a competitive sense, how do you make those evaluations?
Yeah, we are infrastructure investors, which translates into we're boring investors, right? So we don't like too much risk, and so we can use some of your Altera capital when we go outside of the country. But yeah, I mean, look, our funds are global for a reason, and that's because this is a thematic that's relevant for just about every market in the world, right? Not just OECD markets, also emerging in developing markets. So, and as we're seeing today, the diversification of different markets is really important in terms of our investment strategy, because when things aren't going well in the US, you can focus on Japan or Australia or another market. And so there's many levers to continue to deliver returns for our investors. So we do invest in non-OECD countries as well. We can do up to 25% in each of our funds. And we have done a lot of investment outside of the main economies. As you mentioned, we've done a lot of, we've just commissioned a 400 megawatt wind farm in Brazil. We're partnered with another company that's constructing another gigawatt of wind and solar in Brazil. We've invested in Mexico, we've invested in Chile. And that's true across many of the Macquarie business groups. So we're a global-minded company in any case. But I think the important thing to mention is that regardless of where we're investing, we take the same infrastructure underwriting approach. And so we look for downside protection. We look for, when we can, US dollar denominated contracts, long-term contracts, investment grade counterparties. So when we can find that in emerging markets, we're really excited to do that. But it's not easy to find that in emerging markets.
Sure. Well, thank you, Will. We have only a few minutes remaining, but we are getting multiple questions from the audience about what I think we could see as an elephant in the room here, which is the expansion of tariffs that are affecting global trade and have been expanded even more significantly over the past week. So just in roughly a minute or so, I want to ask each of you how the tariff announcements are affecting your outlooks and affecting your thoughts about providing finance to the global energy transition. Let's start with you, Kate.
Mine's a relatively straightforward one because we're mostly financing companies that are based in market, in Nigeria, in Kenya, sourcing from China, where unless there's a disruption directly to that, we hopefully won't see an impact. That doesn't mean that we already have so many challenges with the currency exposure related to those transactions where we lend in dollars, they source equipment in dollars, and then get repaid in local currency. But thus far, the tariff issue shouldn't have a big impact on us.
Oh, I'm so disappointed I can't ask you 5 questions about China, but let's move on. Anmay.
That's scary. Well, I mean, it's interesting that you raised this question because I actually, right before I got here, I had a call with one of our investors who asked the same question. Obviously, this is a very new situation, very dynamic, and right now, I would say there's a bit of a pause. I mean, there's a bit of a, we, of course, are analyzing like all of our investments. We're looking at even the things that we're looking in our pipeline that we were going to invest into as well. But I think people are taking a little bit of a step back, or certainly my team is, just because the situation is so dynamic. It's incredibly difficult to underwrite in uncertainty. Like if it's uncertain, if it's settled, even at a level where you may not be happy with that level, you can underwrite to it, but you cannot, you don't want to underwrite to it because it wouldn't be responsible to your investors on assumption, right? So of course, our existing investments, which are already out there, some of them will benefit, frankly, because the power prices will actually go up. So we'll get, we'll actually do better. But then there's a huge number of our investments that are in development platforms where in capital-intensive investments like we have in climate infrastructure, this will be very impactful on their ability to implement those development pipelines.
Yeah, thanks. Will, final word.
Sure, I'll go quickly because I know you're telling us we're out of time. Agree with everything said. I think for us, it's certainly the hardest part is the uncertainty. I think we just things that we thought were de-risked are now not de-risked, and the economics that we expected to get either are going to deteriorate or we have to renegotiate contracts. That is something that we're preparing to do and spending a lot of time thinking about where we need to do that. But long term, we fundamentally believe the demand for electricity, the growing demand for electricity is so robust right now that eventually, like it won't be next month, but maybe 6, 12, 18 months from now, the market will adjust. There's so much corporate and other demand for power that it's almost an inelastic product right now, right? Like people will pay more for power until they
Literally can't.
until they can't, right? Like, I mean, for data centers, it's a critical input, right? And it's a small part of their actual cost base, right? So you can increase prices. So that's going to happen. Like if we do have tariffs that remain, power prices are going to go up, and we'll sort of return back to the economics that we need to deliver our investor returns.
Perfect place to end. Please join me in thanking our panel.